the forgotten architects of London's credit. It began with men whose names rarely appeared in official records. Quiet figures who worked behind counting house doors, shaping systems the city would one day depend upon. They left no monuments, issued no proclamations, commanded no fleets. Yet their ideas carried a force that would ripple through London streets for centuries. They were the architects of credit, long overlooked, yet essential to the rise of a financial world built on trust rather than coin. London at the time was restless. Trade expanded faster than money could follow. Silver and gold flowed unevenly, arriving in bursts and vanishing just as quickly. Merchants needed more flexibility than metal alone could offer, and lenders needed safeguards stronger than handshake agreements. Amid this tension, a small group of thinkers began sketching the foundations of a new system, one where value could move without waiting for coin to catch up. To understand how revolutionary this was, we must return to a world where money was still thought of as a physical substance. Wealth was counted in weight. Power clinked in pockets. Yet these early innovators saw something different. They understood that trust, if structured carefully, could act as money itself. A promise could be measured. A reputation could carry worth. A future payment could be brought into the present. The reveal began in quiet conversations. Lenders comparing notes on reliable borrowers. Merchants creating written assurances to replace risky verbal commitments. Shopkeepers extending credit based on detailed records rather than intuition. These practices seem mundane, even trivial, but taken together, they formed the scaffolding for something London had never possessed before, a system capable of stretching value across time. This new architecture spread slowly but steadily. Simple ledgers evolved into sophisticated instruments. Personal promises grew into transferable obligations. Networks of trust expanded beyond neighborhoods and guilds, linking people who had never met through chains of credit that hummed beneath the city's daily life. It was invisible to most Londoners, yet it shaped how goods moved, how ventures were financed, how risk was shared. But beneath this quiet rise lay tension. As credit gained power, it also gained uncertainty. If trust could create value, it could also destroy it. If promises circulated freely, they could outgrow the ability of borrowers to fulfill them. And as London began leaning more heavily on this hidden system, the foundations the forgotten architect had built would soon face pressures neither they nor the city were prepared to confront. As credit threads spread through London, what began as cautious experimentation soon became a defining force in the city's commercial life. Merchants who once relied solely on coin found themselves using written obligations to bridge gaps in timing. Lenders extended terms based not on metal stored in chests, but on the reputation of those who sought their help. And shopkeepers, once hesitant to offer goods without immediate payment, began adopting practices that allowed their businesses to grow far beyond the limits of daily cash flow. With each quiet exchange, the architecture of credit expanded. Agreements grew more intricate. Ledgers filled with entries that represented not wealth as it existed in the present, but wealth expected to arrive in the future. This subtle shift transformed commerce from a rigid, transactional world into a flexible system where opportunity could be seized before the coin to fund it physically existed. Credit was no longer a convenience. It was becoming the engine of London's growing ambition. But this rise carried friction. Traditionalists worried that the city was drifting away from the safety of tangible value. They argued that promises, no matter how carefully written, could not equal the certainty of metal. Their warnings grew louder as credit networks pushed into markets where risk was already high. Meanwhile, supporters of the new system countered that without credit, London would suffocate under the weight of its own growth. Expansion required fluidity. Opportunity demanded trust. These debates intensified inside counting houses, where early financial thinkers tested methods to evaluate reliability. Some created scoring systems based on a borrower's past behavior. Others divided loans into smaller risk pools shared by multiple lenders. A few experimented with early forms of collateral agreements that stabilized volatile deals. Their innovations were modest individually, but each one strengthened the system's ability to carry greater weight. Yet even as credit matured, its hidden vulnerabilities began to surface. The more people relied on future promises, the more exposed they became to interruptions in trade, political uncertainty, or personal misfortune. A missed payment in one part of the city could ripple through networks of obligations, straining relationships far removed from the original deal. The web that once offered opportunity now revealed its fragility. Tension grew when a series of small disruptions, late shipments, bankruptcies, disputes over collateral, exposed the absence of standard rules. Some lenders demanded harsh penalties. Others forgave debts too easily, weakening the foundation of trust. Borrowers complained of inconsistency, fearing that their fate depended less on principle than on the temperament of their creditor. The system, though powerful, lacked coherence. The conflict sharpened further when wealthier financiers began to dominate the credit networks. They set terms others felt compelled to accept. Their influence allowed them to extend or restrict opportunity, shaping the city's economic landscape from behind closed doors. Smaller merchants feared being trapped in a system they did not control. Those excluded from credit saw their prospects shrink, while others surged ahead. London could feel the strain deepening. The new structure had enabled extraordinary growth, but had also created invisible pressures no one yet understood. Credit had become the city's lifeblood, and also a source of instability that threatened to undermine everything the forgotten architects had built. The stage was set for a conflict that would reveal the true limits of trust and force London to decide whether its financial future could rest on promises alone. The strain within London's expanding credit networks tightened as the system pushed beyond its natural limits. What had begun as a flexible tool for growth now carried the weight of the entire city's commercial ambition. Every promise, every ledger entry, every extension of trust linked households, merchants, and financiers into webs so dense that a tremor in one corner could unsettle dozens of others. The architecture built by forgotten hands was revealing both its brilliance and its fault lines. Trouble surfaced first among the smaller traders who depended heavily on credit to survive tight margins. A delayed shipment or unexpected expense could transform manageable obligations into crushing burdens. When a series of political disruptions slowed trade across the channel, many found themselves unable to meet repayments. Their creditors, anxious and unprepared, reacted unevenly. Some demanded immediate settlement, others tightened terms, and a few attempted to renegotiate in ways that only deepened their own exposure. What had once been a fluid system became a tangle of conflicting expectations. The tension intensified as wealthier financiers, sensing danger, began pulling back. Lines of credit that had flowed easily for years narrowed. Borrowers who relied on predictable renewals suddenly faced uncertainty. Deals collapsed not because they lacked value, but because trust had thinned. For the first time, London saw how quickly confidence could evaporate when too much depended on promises stretched across time. Merchants responded with growing frustration. They argued that the credit system had become a trap, one where success required constant borrowing, yet borrowing had become increasingly fragile. They blamed financiers for hoarding liquidity, accused rivals of spreading rumors to weaken competitors, and warned that unless stability returned, commerce would grind to a halt. Their anger spread to the docks, markets, and coffee houses where London's pulse beat fastest. Within the counting houses, conflict flared over who bore responsibility for the mounting instability. Some insisted borrowers were reckless, taking on obligations they could never hope to fulfill. Others argued that lenders had grown complacent, expanding credit too easily during prosperous years and withdrawing it too sharply at the first sign of trouble. Each side defended its actions, but both knew the truth. The system had grown far larger than the rules guiding it. The crisis deepened when a prominent merchant house defaulted on several major obligations. The news struck like a crack of thunder. Creditors scrambled to assess their exposure. Partners questioned whether they too might fail. Smaller firms, tied to the fallen house through chains of debt, felt the ground shift beneath them. What had begun as an isolated failure now threatened to become a cascade. Fear spread through the city. Contracts that once moved smoothly now stalled. Creditors refused new agreements unless collateral was immediate and overwhelming. Borrowers, desperate to stay afloat, liquidated assets at fire sale prices. Markets wavered under strain. The invisible web of obligations that had quietly supported London's rise now seemed ready to collapse upon itself. In the midst of the turmoil, something essential became clear. The architect of credit had built a system of extraordinary potential, but not one designed to withstand widespread panic. Their innovations had linked people together in ways no previous generation had imagined. Yet those same connections carried risk like fire through dry timber. London stood on the edge of a breaking point. The question now was whether the city could stabilize a system built on trust when trust itself was slipping away. The breaking point arrived when multiple merchant houses, each tied to the others through chains of credit, collapsed in rapid succession. What began as a single failure swelled into a cascade, sweeping through networks that had once seemed stable. Ledgers filled with obligations that could no longer be met. Creditors pounded on doors that would never reopen. Borrowers vanished into the fog of insolvency. The elegant architecture of trust, built quietly over decades, now shuddered under the weight of fear. Markets reacted instantly. Prices plummeted as merchants liquidated goods in desperation. Lenders refused even the safest proposals, hoarding what little liquidity remained. The exchanges that once buzzed with ambition now echoed with uncertainty. Bargains vanished. Opportunity froze. A system designed to extend value into the future could not withstand a present shaped by panic. Yet amid the turmoil, a realization took hold, slowly at first, then with undeniable clarity. The crisis did not stem from the concept of credit itself, but from its lack of structure. The forgotten architects had built the foundation, but not the walls. They created a system of extraordinary reach, but offered no safeguards against widespread collapse. Their tools needed rules. Their innovations needed boundaries. In the aftermath of the worst failures, leaders from across London's commercial world gathered to confront the problem. Merchants, financiers, and officials who had spent years arguing now sat side by side in emergency meetings, forced into cooperation by necessity. They debated fiercely. They blamed one another. Yet through that conflict emerged the first blueprint for modern credit governance. They agreed that obligations must be recorded uniformly, that collateral rules must be clear, that lenders must hold reserves strong enough to survive sudden shocks, that borrowers must be evaluated by standards, not whims. They established oversight mechanisms to trace the chains of credit that once lay hidden. Slowly, deliberately, London began to transform chaos into coherence. As these reforms took hold, confidence, fragile but present, returned. Credit lines reopened, markets steadied, merchants resumed their ventures with renewed caution. The system, once on the brink of collapse, began to function again, not as a patchwork of personal promises, but as a structured, accountable framework capable of sustaining growth without succumbing to fear. London emerged changed. The forgotten architects had shaped the early contours of credit, but it was crisis that completed their work. Their invisible innovations became the backbone of a system strong enough to support an empire, precisely because it had survived a moment when everything seemed ready to fall. What the city learned was simple yet profound. Trust is powerful, but trust alone is not enough. It must be strengthened by clarity, reinforced by oversight, and supported by rules that protect the system from its own success.